to make sure that the cash flows generated by the project will be highly secured. Okay, this is the condition to be able to raise the type of debt which we are going to explain and to present, to discuss later on in this course. Okay, so as far as risk analysis is concerned, indeed the first step was to identify the risk, okay, and to try to define priorities to identify the most potentially severe risk, okay, and now we reach a point where the idea was to introduce few metrics which are used in risk management to kind of measure the importance of the risk. So let's move to the slide which corresponds to that point and where we stopped yesterday. So here it is. Okay. So all the measures are based on a probabilistic approach. Whether it's relevant, that's another story, which we will have to discuss also, because probabilities are not quite easy to obtain, particularly if the project is what we call a greenfield project. You have no similar project that exists, for instance, then we have no historical data. So you have to be careful with the use of probabilities, but nevertheless, some measures exist and you have to know them if you want to be, as I like to say, member of the club. One tool which is very much used today, and I would say which is also very useful as far as project analysis is concerned, is what we call simulation tools, okay? And so we'll spend a bit of time to make sure. I guess that some of you are familiar with that, but I'm not so sure. And it's clear that all of you must be aware of what it is and how it works, okay? And then we're going to look at few measures which are commonly used today, which were introduced first in the banking sector, you know, and you probably have heard from my colleague the concept of value at risk. Some of you are probably quite familiar with it already, okay? So the value at risk and the earning at risk, which are two key concepts which are now used in risk assessment, okay, and which we are going to look at with details. Well, so let me remind you how we represent risk in finance. If you take, for instance, your corporate finance textbook, if you look at the chapter about risk and return, well, what is risk all about? Well, usually to modelize risk, we use a matrix like this one, which you have on the screen, you know, where you can describe the project. You start with the idea that you don't exactly know what's going to happen in the future, particularly if you have a long-term view, let's say 20 years, okay? So you have to imagine several scenarios, okay? So that's the first line. There are several scenarios, which it will depend, for instance, if you decide to develop a project in a particular country, what about the political stability? What about inflation? What about the exchange rate movements? What about any element that might have an importance for the environment where you are going to operate for the future, okay? And you can imagine a certain number of scenarios. Well, a very common practice is to use only a model with three scenarios. Well, you would have the central scenario, okay, the most likely, okay? Then the best case you can imagine that would lead indeed to the best, the highest level of return for the project, but also what we call the worst case scenario, what would be in the worst case, what would be the situation, okay? Well, once you have identified the different scenarios, well, for each of these scenarios, based on different parameters, okay, you will try to determine what will be the outcome. So what type of outcome are we looking at? If you analyze a particular project, well, indeed, you may look at the net present value or the internal rate of return or any other financial, let's say, assessment of performance, okay? But let's say, for instance, for the simplicity of the discussion, let's say that we would consider either the NPV or the internal rate of return. Well, now you have different scenarios. For each, you have been able to measure or to estimate the potential outcome, okay? And now some scenario might be more likely than others. That's where you would have a probability for each of these. Hence, this matrix which is one column per scenario, okay, with line for the number of the scenario itself, and then the outcome, and then the probability for this particular scenario. Okay, so if you look at this, you can obtain directly a graph like this one, which you are very familiar with. Okay, on the horizontal axis, you will measure the outcome. Here again, let's consider the net present value or the internal rate of return, and the probability would be measured on the vertical axis, and then you obtain a probability distribution. In this very simple case, we have only 3 scenarios, which is, as I told you, a very common practice, okay? With the central scenario, which, and it is often the case, which is often considered as the most likely. How to get the probabilities, that's another story. We're going to see that later on, okay? But you can have a more complete description of that, because here you have a kind of distribution which is discrete with only 3 values, okay? The use of simulation will allow you to get, rather than these 3 columns, to get a probability curve, okay, a full probability distribution, which can be obtained using simulation tools, okay? Well, so a few comments on this. Basically, that's the way risk is represented in finance, okay? So a few comments on that. As I told you already, simulations can be carried out to obtain this type of probability distribution. The basic methodology, which some of you may have heard of already, which is a Monte Carlo approach, okay? Well, so we'll see that more precisely in a minute. Well, now, you know that in corporate finance, and you have it in your textbook, there is a very common practice, which is to use a standard deviation as a measure of risk. Why do we use a standard deviation? Because it's an easy kind of measure, very convenient. Why? I know you are specialist in statistics because you had an excellent professor, with Professor Chan, okay? So you know that if you know both the mean and the standard deviation of a normal distribution, then the normal distribution is totally defined, okay? In other words, when you use a standard deviation, you implicitly assume that you are using a normal distribution, okay? Well, which is a quite easy to manipulate type of distribution. It is a so-called bell curve, as you know, okay? And then you can develop all type of models, using the standard deviation and the means. You have, for instance, think of the CAPM, the capital asset pricing model, which you also have seen in corporate finance. We use different formula with covariance and so on. All that is based on the mean variance approach, assuming a normal distribution. As far as risk management is concerned, and as far as we are concerned here in project finance, you have to be careful with that. Okay, why? Because there is something which is well known. Probably my colleagues already told that to you, that if you assume a normal distribution, you tend to underestimate the probability of extreme events. Okay, it is well known that, for instance, some traders have cheated in the, when I say the traders, I mean the whole banking system. They have kind of cheated when showing the risk exposure they had by using this normal distribution. They were implicitly, but most of them knew about it, okay, they were implicitly underestimating the risk of extreme event. And now, after the crisis of 2008, that looking at extreme events and is a key point when you think of the financial instability that might result from the too high risk exposures, okay? So be careful, and it's not necessarily, of course, for the sake of simplicity, I will use a normal distribution in the next slides, okay? But you have to be careful in real life, You may try to use some other type of distribution, typically a gamma distribution, which is a very common assumption also. Well, what else? Most importantly, factors affecting significantly the outcome should be identified. For each scenario, you calculate an outcome. Because for each scenario, you may have a certain growth rate for the economy where you operate, a certain inflation rate, okay, a certain foreign exchange rate, and all these parameters will have an influence on the net present value of the project, okay? Well, it is important to know if one of the parameters which has an influence on the outcome is more influential than others. Simulation allows to look at this. Okay, that's why I want to say a few words about simulation, because it's too important in terms of project risk analysis. Okay, so simulation can be used to identify if some parameters are more influential than others. Indeed, if you can show that one parameter, let's say the foreign exchange rate, has a strong influence on the final outcome, then what does it mean? It means that either you need to have a good prevision of the foreign exchange rate, and if you cannot, if you are really exposed to the volatility of this exchange rate, try to find a way to hedge it, to hedge that risk, because that risk would be very much important and would have a strong influence on your outcome. It depends a lot from this parameter. This can be seen through the simulation, and therefore try to find a way to get protected against this particular parameter. Okay? What else? Well, there is a question also that one should always be able to answer. It's again about the problem of extreme events, of extreme events. You should always ask the question, what if the worst case scenario occurs? Okay? In the worst case, how much would we lose, basically? That indeed, if you are an equity holder, you know that what you can lose is just your equity. Okay, so there is a limit. But if you are a lender, okay, if you lend up to 70% of the fund needed for the project, well, you may like to know whether the losses would be so high that you may not get your money back. So lenders are very much concerned with that. Okay, so and here we introduce a concept which I'm going to use further, which is the concept of critical loss. If you launch a project, you know that there is a risk behind it. Okay, you know that it's possible that you're going to lose money. It's part of the game. If you are an entrepreneur, okay, you like risk because even though you know that you can lose money, you expect that the chance of making money are large enough to justify your investment. Okay, but you know that you might incur losses. The question is, well, how much? And there is a limit to what you are ready to lose, okay, which is this idea of critical loss, which is introduced here. And then there is a kind of measure of risk, which is very often used now, or an indicator of risk, more than a measure, which is what is the probability to have a loss higher than this critical loss. If, for instance, you say, well, we wouldn't like to lose more than 1 million euro on this project, okay, well, the question is, what is the probability of losing more than 1 million? If you find that the probability is 10%, you will say, oh my God, that's the probability is much too high. I don't want to take such a risk, okay? If you find that if your estimate is that the probability is only 0.5%, then you feel more comfortable, okay? So since the concept of critical loss is important, I think it's worth discussing a bit how it can be measured, how it can be obtained. And there are different levels of different thresholds that can be considered, and it will depend on who you are and how much you're ready to lose. Well, the very first concept, I would say the soft concept of critical loss, is if you have a return which might even be positive, but which is below the required profit. Okay, you have investors, okay, they provide funds for the project and they expect a return on it. They consider that based on the risks they take, they deserve a certain level of profit, which is what we call traditionally the fair return. How to calculate a fair return, you know how to do it. You know about the CAPM, capital asset pricing model. You can use the risk-free rate, the risk premium, and all that. You know the story, okay? So if you have a return which is below the expected return of shareholders, if you consider shareholders, or in other words, if you have a return on capital employed or an internal rate of return which is lower than the WACC, okay, which would mean that the NPV also would be negative, then, as we say, you destroy value. So value destruction, which does not correspond to a negative return, okay, but a return which is lower than what investors can normally expect, is the very first level which we can be considered as a critical loss. Well, but this is not really what we're concerned here. we are more concerned with what's coming now. The second concept that we can introduce is a threshold at zero profit. Okay, why? Because if you are below zero, it means you have a capital loss. You have less, you invest 1 million and you get, in the end, you get less than 1 million. So usually people are not quite happy with it. Well, they can survive. That's why it's not that critical. Okay, but they don't like it. So if you have projects which regularly generate a loss, well, it's maybe difficult in the end to attract investors. But indeed, what we are most concerned with is the default. Okay, that would lead to the interruption of the project, because it would be such a critical loss that you would have a liquidity crisis, which means that the project could not continue because of the importance of losses that nobody could pay for. Okay, in this case, indeed, lenders are very much concerned, because it means that the project would just stop and they would not get their money back. And since they have the cash flows are their main guarantee, it's indeed this type of critical threshold that we are interested in. Okay. Well, so having said that, now I told you that these curves can be obtained through a simulation exercise. So let's try to see how it works. So representing uncertainty using simulations. So there are basically 3 steps. The first step is to identify the random parameters influencing the estimated outcome. For each scenario, we want to estimate an outcome, okay? And I'm taking a very simple example here. Let's assume that what you want to know is the amount of sales for a period of time, let's say for 1 year. And you will say that sales are price times quantity, okay? But indeed, you don't know exactly at which price you will be able to sell. And for this price, you don't know exactly what are the quantities. Okay, so price and quantity here, in this very, very simple example, are the 2 parameters which will determine the level of sales. Okay, we could indeed assume a correlation between price and quantity. Well, for the sake of simplicity, we are going to assume, but this is indeed totally unrealistic, but it's not a pedagogical problem. Okay, let's consider that these 2 parameters, price and quantity, are independent. Okay, so your outcome is the sales, and you would like to obtain the probability distribution of the sales, which depends on price and quantity, which are both random factors. So what you need, the second step, is to say, well, for each random parameter, here price and quantity, you have to translate your mostly subjective knowledge into probabilities. Why do I say subjective knowledge? Well, how can you have an idea about the average price and its volatility? Well, you can go and see your marketing team. Maybe these guys, they have an understanding of the market, how it works locally, okay? And they would tell you, well, on average, you can expect this price, but it can fluctuate in a certain range. And the same for the quantities, okay? So, and we'll see in a minute how you can transform this subjective knowledge which you have into probabilities. Once you have these probabilities, and we'll see how to get them, okay? Once you have these probabilities, then now you can combine the 2, price and quantity, to obtain the sales. And based on the probabilistic representation which you have, you produce a series of estimates to obtain a distribution of the outcomes, in this case of the sales. For instance, if you look at this matrix which is there, in the first column you have the price, okay? And here I have just few lines, but each line represents 1 simulation. And as you'll see on the next slide, you can have 1,000 simulations like this. It's quite easy to do now using the type of tools which we have. You can use Excel tables to do that. So you see, you will, because you know the probabilistic characteristics of the price, you can develop a series of 1,000 prices which will be distributed following the probabilistic characteristic of the price. You do the same for the quantity, then you will have 1,000 numbers for the quantities, And these numbers will be distributed following a certain probability curve, which corresponds to what you have assumed. And then for each line, you will take price time quantity, and you obtain for each line an amount of sales. So the last column gives you a series of 1,000 cells, assuming that we have done this 1,000 simulation, a series of 1,000 numbers, which will correspond to the combination of the two random parameters, price and quantity. And therefore, you will have your distribution of sales. So let's try to see more technically how we can do that, okay? So I start with a question. Well, you know, for instance, we have been looking at wind farms. So let's keep this example of wind farms, okay? One parameter which might have an influence on the project is for how long can you use a wind turbine? There are some best guess. I mean, some experts would say, well, this number of years, some would say 15, some 20, some 25, you know. Nobody knows exactly what is the expected life of wind turbine today. It's too early. But anyway, the turbines we're using now are brand new. We have no experience for these. We have an experience for kind of turbine which were installed maybe 10, 15 years ago, but which are no longer the type of technology which we're using now. So you have no historical reference for that, okay? That's why it is more or less subjective. So my question would be to you, what is your lowest and highest estimate? In other words, I don't ask you to tell me the value would be 20. No, because you know that it's quite uncertain, okay? But you might tell me, well, my belief is that it is, let's say, between 20 and 30 years, okay? You know, when you give a range between 20 and 30 years, you just tell that you don't know exactly. You know, it's very likely to be in this range. In other words, my question was, what is your lowest and highest estimate so that the probability of the true value being in this range is 95%? If you answer me 20 to 30 years, then it means I would consider that you consider that there is 95% probability for the life of a wind turbine to be between 20 and 30 years, okay? So, having said that, what can we do? So this is your answer, okay? So 95% probability to be between 20 and 30 years, with a mean which is 25, okay? Which is your best guess to a certain extent. You say, you probably consider that it is more likely to be in the center of the range rather than being at the extreme, okay? So the mean is 25, okay? Indeed, you can be out of the range. In fact, it may happen. It may happen, but your estimate implicitly is that the probability of this to occur would be only 5%, 2.5% on each side, because you have 95% probability in the range between 20 and 30. So now, again, I will ask you to remember the properties of a normal distribution, which you have studied with Chan, okay? So you see, this is the famous bell curve. Why are we going to use it? Because it's very convenient here, as you see. You see, if I take 95%, you know, 95% probability for this curve, if you start from the center, 0, is between +2 standard deviation and -2 standard deviation. You know, if you look at it, it's not exactly 95%, but it's close to 95%. You see, if you add up 13.6 plus 13.4.1 plus again 34.1 plus 13.6, then you get something which is very, very close to 95%. In other words, if I take the answer here, okay, you have 95% to be between 20 and 30. If you take a mean of 25, okay, it means that the distance between 25 and 20, if you assume a normal distribution, is 2 standard deviation. Okay? the distance here would correspond to 2 standard deviation. So the standard deviation is what we are looking for, okay? And it's easy to find because if 2 standard deviation correspond to a value of 5 years in this case, then it means that the standard deviation is 2.5. In other words, what it means, if you tell me, if your estimate is to say that there is 95% chance that the expected life of the turbine is between 20 and 30 years, it means that implicitly, if you assume a normal distribution, and it's subjectively, it's very common, to assume a normal distribution. Well, it means more precisely that you assume a distribution which is centered on 25 years with a standard deviation of 2.5. Okay, so, and this type of thing, you can do it for each parameter which has an influence on the outcome of your project. Okay, so now, if you have understood how we can transform your subjective knowledge, your subjective uncertainty into a probability distribution, this is what we have done here. We started from, let's say, a vague knowledge of the situation where you say, well, I think that, well, there is a 95% chance that the number of years is between 20 and 30, we can transform this into a probability distribution. Well, but, some people might be expert in the field. They might tell me, oh no, I'm pretty sure that, the range is more like between 20 and 25, and it would be centered on 22.5. Okay, so this other person would have a more precise view, okay, and it would correspond to another mean at a smaller standard deviation, because the range is smaller. The smaller the range, the smaller the standard deviation indeed. Okay, so some people have a better knowledge than others. If you really are not a specialist, you don't know anything, you might say, oh my God, I would never guess, let's say between 10 and 40. Okay, if you have a large range, it's a way to say, well, I know nothing about it. So I'm going to take a very large range to make sure that I will be in. Okay, but those who have a better knowledge and a better understanding of the situation, they are able to provide you with a narrower range. Okay, that's why when you develop this type of simulation, make sure that don't do everything yourself. In using and playing with your Excel, you need to find for each parameter the expert, the person you consider has the strongest legitimacy to tell you numbers and to give you an opinion. Okay, the worst situation is when students are playing or people are playing with their Excel table. I like to tell a story to my students usually. When I was a kid at school, I was writing stupid things on my papers, and my professor was telling me, paper does not reject ink. Okay, meaning that you can always write, a paper, and you will have words on this paper. It doesn't mean that what you write makes sense. Okay. Well, now I like to tell my students, be careful, because Excel does not reject numbers. Okay, so you can play with your Excel, you can have a marvelous quantification with nice probabilities and the like, but if to start with your input is based on no knowledge, no expertise, don't trust, you have no reliability in the numbers you get in the end. Okay, and that, it can be a dangerous game to put numbers everywhere if you don't have the expertise that kind of allow you to give an opinion. Well, so let's assume you have, I hope you have understand this approach. Now, let's take a simulation now, a more complete example. So we're looking to look at a project, and to make it simple again, we are just focusing on the EBITDA. Well, a very simple definition of the EBITDA would be sales minus expenses, okay? So the sales here would be expressed in euros, but you sell abroad with prices in dollars and a certain quantity. So if you look at the sales is the price in dollars times the quantity times the exchange rate, the value of $1 in euros, okay? Well, what about expenses? We will make a distinction between variable expenses and fixed expenses. So the EBITDA, and here you have the different parameters that will determine the EBITDA in the end, which is our outcome for this case. It's the price in dollar times the quantity times the exchange rate minus variable cost minus fixed cost. So now we need to identify the probabilistic properties of each of these parameters. So let's assume this. For the price, let's assume, for the sake of simplicity, that I'm going to fix the price. So if I fix it, there is no uncertainty about it. In other words, if I fix the price at 50, the mean would be 50 and the standard deviation will be 0 because I fix it and it's not random. Okay? What about the quantity? For this price, if you fix the price, you never know exactly how the market will react. Okay? So you estimate the mean would be 2000. Okay? But you assume that the standard deviation would be 400. How did you get that? Exactly using an approach similar to what we have done for the life of a wind turbine. Okay? You ask your marketing people, they know the market well, and they might tell you what is quantity you can expect and to a degree of volatility. Okay? What about the exchange rate? In this case, you could consider that you have historical data. You know, you look at the recent past here, so it would be less subjective because you have historical data. And let's assume that you would have an exchange rate of 0.9. In other words, that $1 would be 0.9 euro. And you observe a volatility in the recent past so that you can assume it makes sense, which is 0.2 for the standard deviation. What about variable cost per unit? Well, indeed, we could look at the detail of variable cost, but it would mostly comes from, let's say, some raw materials which you use. It could be energy, whatever you like. Let's say that the mean would be 3 per unit, okay, with a standard deviation of 0.3. What about the fixed cost? Well, you can assume that you know the fixed cost, that they are not random. Let's do this. So you assume that the fixed cost would be 40,000, okay? And since they are known, then the standard deviation is 0. So here in this table, we have made the assumptions. We have transformed our, let's say, more or less subjective knowledge into probabilistic elements, okay? Basically, the mean and the standard deviation. And here, by doing so, it means that we are assuming implicitly a normal distribution. It's not an obligation, but you know, it's much simpler just to explain to you how simulation works. So what are we going to do now? Well, we are going to make simulation. So what do you have in this? What do you have in this table? If you look at the price first, so there is no ambiguity. So you have 1,000 line, which means that in this case, I have done 1,000 simulations. And don't worry, I didn't calculate 1,000 times this, you know. I just add the first line and then you can copy and paste and you have 1,000 simulation in a matter of few seconds, okay? Well, so if you look at the price is always 50. That's normal. And you have a mean of 50 in the column here, because 50 is the price I have fixed, and therefore the standard deviation is 0. You will always have 50. What about the quantity? The quantity, you see, you have an average, a mean of 2,000, you have assumed that, with a standard deviation of 400. I have used Excel to generate a distribution of 1,000 values following a normal distribution with a mean of 2,000 and a standard deviation of 400. Now, just to verify whether it's true or not, if you take all the 1,000 numbers for the quantity, if you look at the mean, what do you find? 1993. So it's not exactly 2,000, but it is close to it. Would you have 10,000 simulations? You would be much closer to 2,000. What about the standard deviation? It is not exactly 400, but it is 404, 405, okay, which is also close to 400. Again, with 10,000 rather than 1,000 simulation, we would have a mean close to 2,000 and a standard deviation even closer to 400. So you might ask me, but how did you get that? Usually I have the question systematically, okay? It's easy to generate with Excel. I decided to add it in the slide. The problem is that you don't have the PowerPoint file because I think that it has been transformed into a PDF. But you can take this link here. We will do it together right now, you see? And it brings you to a file where you have an explanation on how to create a normally distributed set of random numbers in Excel. Okay? They will explain everything, what a normal distribution is, and so on, and how do you do to get the numbers I have in this simulation. Okay? So I'm not going to explain you that, but you just have to accept the fact.
Đây, bình thường. Dạ, vừa mới vào.
No. Yeah. Okay. Okay.
Hi, can you hear me?
Okay. Yeah. I am back. So
Yes,
you
you are back.
it was interrupted.
I don't know
I
what
mean,
happened. Maybe the internet connection from the side.
okay. No, actually, I know what may have happened. Someone called me, and when I didn't shut down my mobile phone, and then when they call me, it goes to my computer, and that's probably why it was interrupted, and I didn't realize. When did it? Could you tell me when it stopped?
Hi. Let me
Do you
see.
remember roughly? Do you know roughly where it was? Can you hear me?
the break end already. I sent to
Okay.
students at 8 p.m.
Okay. So I should start again. Can you
Yeah,
just give me 5 minutes? Can you give me 5 minutes then?
Yeah, that's okay.
Okay. I'll be back
Yeah.
in 5 minutes, not more than this.
Oui,
Ok.
d'accord, d'accord.
Merci. Faut que je refasse la simulation, tout. Bordel. Quelle merde. Groupe Marie Porte ouvert 3 mes amis. Chier. J'ai coupé mon téléphone. Sinon, j'ai pas de bac.
Ouais, mais là, on va continuer à nous en... On devrait leur dire, écoutez, ou vous arrêtez ça. Si vous n'arrêtez pas, nous, on n'achète plus de Renault. Hein. On a toujours acheté. Alors là, on a qu'à leur dire ça. C'est pas possible, Patrick.
Peut-être que je les mette.
Hein?
Peut-être qu'il y a certainement un moyen de faire une sorte. Ça, c'est le bordel. Pourquoi pas? Quand il voit même pas que...
Voilà. Je pensais, eh bien, t'as pas appelé aussitôt?
Non, parce qu'elle était chez elle. Elle ne les a pas contactés, elle a essayé de me contacter.
Oui, mais ça a mis un petit temps. Oui, mais c'est pour ça que j'ai pensé que tu laissais ton téléphone ouvert. Parce que si tu n'as pas de téléphone, tu sais rien.
Ah oui. Je vais te le laisser. Je vérifierai s'il y a un coup de fil, si je suis pas occupé.
Oui.
J'ai commencé à 3h, 6h. Il y a 6h.
C'est-à-dire que dès qu'il y a un truc. Alors, si c'est Renault, je fais quoi? Mais non, faut que je te le dise.
Tu décroches. Non, mais c'est des messages. On va voir.
Oui, mais il faut que tu vérifies que ce ne soit pas ça. Ça change rien.
Okay, so if I understand well, it all stopped when I started from this slide. Can you correct? Can you? So we have seen this slide, and it stopped when I started with this simulation. Is that correct? Is that correct, Lynn? So I start again with this. A minute. Okay, so you've seen that I'm not going to click there again because apparently it does interrupt the presentation. Okay, but you have the web link here if you want to know more about how to generate a normal distribution. So you remember here what we were doing. We have we want to look at the EBITDA. We have the different parameters here, and we have made some assumptions for each of these parameters instead of mean and standard deviation. Now, to make the simulation, we have this table. In each column, what do you have? You have the price, quantity, exchange rate, and so on, each of the parameters. And in each column, you have numbers, 1,000 numbers exactly, because I have done, for this example, 1,000 simulations. And the series of numbers follow a normal distribution with a mean that corresponds to the assumption and a standard deviation that also corresponds to the assumption made, which is in the matrix here. Okay, and for instance, as I said, the quantity here, we have assumed a mean value of 2,000 and a standard deviation of 400. So you have 1,000 values here, which are distributed normally with a mean of 2,000 and a standard deviation of 400. When you make the calculation of the mean of these values and the standard deviation, you don't find exactly 2,000 and 400, but close to it. 1993 and 404 here. Well, would you have, rather than 1,000, something like 10,000 lines, you would be closer and closer from your assumptions. Okay? So, and I was saying that if you want to know how to generate such a distribution with a mean of 2,000 and a standard deviation of 400, go to this web link, okay, and you have the explanation. Okay, and it can be used with Excel. So I did the same for the exchange rate with these assumptions here. The same for each parameter, okay? And after that, for each line, I can calculate the sales. And the sales, indeed, are also distributed following a certain distribution, which is the combination of all the probability distribution of these parameters. And you obtain a distribution of sales, which is like this, okay? Where you have a probability. In this case, if you are concerned with EBITDA, which are negative, you just realize, for instance, that you have a probability of 3.3% of a probability of an EBITDA below zero. Okay, in other words, it means that you have, if you look at the number of cases where it is negative, it corresponds to 3.3% of the values which you have here. Okay, so that's the way you can generate a probability distribution. You can use the frequency curve like this. You could also use, if you prefer, the cumulative probability curve, which would be like this, okay, leading to the same results. It's such a different way to represent the distribution, okay? So that's the principle of simulation. Indeed, it is a very simple exercise using Excel. Well, now you have Excel is not the best tool to do that, and you have a lot of softwares available now, easy to use, which can be used to friendly to develop this type of exercise. Okay, I'm not going to recommend any to you because probably you have some specific program and software that exists in Vietnam, and I let you look for it. Okay, but if you are able to do it, and if you understand how it's done through Excel, well, you would have a perfect understanding of how it works. Okay, well, there is just one point I want to to insist on and give a precision. This is a very simplified version, and in particular, I have made an assumption here that there was no correlation. We could imagine that, for instance, some parameters are correlated. The exchange rate, for instance, could be correlated with variable cost. If within the variable cost you have some raw material, it could be a commodity, for instance, with a price that fluctuates together with the dollar, okay, and then obviously they will have a correlation between the exchange rate and the level of variable cost. This should be taken into account, indeed. I didn't do it here, okay, because with Excel it's not that simple, but with all the software that exists for simulation, you have the possibility to introduce a correlation coefficient for two variables. You have a matrix of coefficient correlation, and you can indicate whatever you want based on the assumption you can make. Okay? Well, so this is just for the first phase, how to generate a distribution of your outcome, which could be the NPV or the internal rate of return. So now we have a distribution, okay? And we are now going to look at a distribution more precisely of losses. Why? Because I want to introduce, to start with, the concept of value at risk. And the value at risk refer to potential losses. So rather than looking at the earnings, I would look at the negative earning, okay? The possibility of losses. So you have a probability curve of losses here, okay? So the value at risk, some of you are probably familiar with it. You have the expected loss. I don't want to comment too much on it because, you know, the expected loss for a project doesn't make much sense, because the expected loss is meaningful if you have a large number of cases. If you have a portfolio of risk, well, typically we can take the example of a bank, you know, with a lot of clients, with a lot of credits in its portfolio, then there is a loss distribution, and the expected loss makes sense because, you know, it's an estimate of the average loss that you might incur due to the fact that some clients will not repay their loan, for instance. And when you have a large number of people, you are like an insurer, and you can have a rather precise estimate because the distribution would have a narrow variance, okay, a small standard deviation or a small volatility, okay? But with a project which is a unique risk, okay, which is not part of a vast portfolio, well, you have a curve of losses, and the expected loss is not quite meaningful, okay? So what you are interested in, remember, is, well, the possibility of large losses, okay? So we will introduce the concept of value at risk, which, as you probably know, has been introduced in the first place in the banking industry, but which is now widely used in many other areas. Okay, so we start with choosing a probability, let's say alpha percent, okay? Alpha percent, and alpha should be a small number. Usually it is in the range of, let's say, about 1%. It could be lower than this, but let's take 1% again. So 1%, you take it here, and you try to find the line, the limit, which corresponds to 1% on the curve. In other words, you are looking for the limit, okay, here, which means that you see that the probability of a loss higher than this limit is just alpha percent. So the definition of the value at risk is this: the probability of a loss higher than the value at risk is just alpha percent. So to get it, you start with the probability distribution. You take alpha percent here, and when you reach alpha percent below the curve, on the right side of the curve, then you reach the limit which corresponds to the value at risk. Okay? So why do we do that? To understand the meaning of it and the usefulness of the value at risk, we are going now to introduce another concept. Not another concept, which is, because we already mentioned it, it is a concept of critical loss, okay? And risk limit, if you prefer. The decision maker, for instance, might decide that the probability of a loss higher than a critical threshold C should not exceed alpha percent. alpha percent being the same as the alpha percent I have chosen for my value at risk. Let's take 1%. Okay? And let's assume that the value would be there. Okay? The value would be there, C. Sometime, the difference between the expected loss and the critical loss, we call it the safety margin. If you have an expected loss, that is considered as a kind of normal loss. Not normal in the sense that, well, it has to be, but in the sense, well, that there are possible losses, and on average, you can count on a loss of this amount, okay? But your concern is, what if we have a loss much higher than this expected loss, okay? Well, the concept of critical loss is a kind of limit. If you go beyond this limit, it means that you have consumed all of your safety margin. That's why sometimes we call this distance between the expected loss and the critical losses safety margin, or the capital at risk. It corresponds to, if you look at the balance sheet of a company, well, it corresponds to a tranche of your equity, which you have allocated to a particular project. Okay? So if you allocate a certain tranche of equity to a particular project, well, this is a kind of safety margin. Equity is there to cover loss which are above what is expected. Okay? So let's come back to our critical loss. So here the situation acceptable here. No, it's not. Because if your objective is to make sure that the probability of a loss will be lower than alpha percent, okay, you can see that in this case, it is obviously higher than alpha percent, because the value at risk is higher than C. If the value at risk is higher than C, is on the right side of C, it means obviously that the probability of a loss higher than C is higher than alpha percent. Okay? In other words, this situation is not acceptable. So you see how the value at risk is used. You don't just look at the value at risk in itself. If you find 1.5 million, well, and so what? Okay. But you compare that to what you are ready to lose with a certain probability. If you say my limit is 1 million with 1% probability, in other words, I don't want the probability of a loss higher than 1 million to be higher than 1%. And if your value at risk is 1.5 million, you say, no, I don't take it. If the value at risk is above my limit, it means that the probability of a loss higher than my limit is higher than 1%. Okay, so it's not acceptable. Okay, so that's the way you use the value at risk. You compare it to a risk limit. Okay, well, now there is another point to mention and to discuss a bit, which is that the value at risk doesn't tell you everything about the potential high losses. Okay, it tells you that the probability to be above the value at risk is alpha percent. But how far above can it be? There is no indication about the maximum loss that you can incur. Okay? Sometimes we calculate, and this is what you find on the slide here, okay? The conditional value at risk. The conditional value at risk is if we are above the value at risk, what is the average value? So it is the average loss when you are beyond the value at risk, okay? That's one type of indicator. But most often what is needed is a stress test. The stress test is a kind of exercise, a brainstorming exercise, to imagine the worst case scenario and try to see what would be in this case, if the worst case scenario occurs, what would be the losses. Then you try to estimate the maximum possible loss. Stress tests are regularly made by banks. It's part of the banking regulation. But now there are also all these concepts of value at risk and stress tests have been transferred to many other areas than just banking as a way to analyze and quantify the risk exposure. Okay? So here we are. So just coming back to our situation, this is not acceptable because we would have a risk limit which is below the value at risk. Okay? So we have to change, you have to find a solution. Those who are in charge, they might to identify the most sensitive parameters and try through hedging or through any mitigation process through contracting, maybe, to find a way to change the risk exposure. And to changing the risk exposure means changing the distribution of possible losses. For instance, trying to take action so that you would have a shift to the left of the distribution of losses, with a lower expected loss indeed, but also a lower extreme losses. Okay? In this case, we reach a situation where the value at risk is lower than the critical loss. In other words, the probability of a critical loss is lower than alpha%, and therefore the situation is acceptable. That's the way the value at risk can be used. But in fact, when it comes to project management, indeed we look at losses, but losses are just negative earnings. So it is more common in project finance to look at the earning curve rather than looking at the loss curve. Okay? So again, if you have a project, you can use simulation, as we have seen, okay? And through a series of simulation, then you can obtain a distribution of earnings. The earning might be, again, the NPV, or it could be the internal rate of return, or the EBITDA, as we have done before, okay? Let's take any of these, okay? Well, so you have a probability distribution with 0 somewhere, meaning that if you are on the left side of 0, you are in a loss area, okay? You have a negative return, okay, or a negative income. Well, and this can be obtained from simulations, as we said. So, what is the expected earning at risk? Well, the definition is very similar. You take alpha%, and you find the limit which corresponds to alpha% for the left part of the curve. So you look at the lowest possible earnings, okay? And when you reach alpha% under the curve, you determine this limit, L here, which is the earning at risk. Okay, the earning at risk is this level here, okay? The position with the position of L. And then you have different situations, okay? If your critical loss is there, the first line here, the first arrow, red arrow, well, you see that it is not acceptable. Why? Because if your critical limit is there, it means that the probability of earning below that line is higher than alpha%. So it's not acceptable. So it's exactly the same approach. If now your critical limit is there, the extreme left, then you see that the situation is acceptable because obviously the probability of earnings below that critical threshold, the probability is then lower than alpha%. Okay, so you use exactly the same rule, except that now you are looking at earnings rather than looking at losses. So it is more what is used in project finance, and it is now very commonly used. You know, you have simulations and so on, and you look at all the patterns that are feasible, and you end up with a probability curve that tells you about the level of risk exposure. Indeed, we don't look at the right side, but the right side is also quite attractive, you know, because it tells you that you can have a final return which is higher than expected, which is indeed the upside risk, which is always attractive. Okay? And we can also have the same approach in terms of stress test to analyze the worst case scenario and try to find what would be the maximum possible loss. Well, so now how to use this? Maybe we can look at a few simple cases to make sure that you have a clear understanding of that. So let's assume that you have estimates, to take a simple case, rather than a full curve, okay? But you have an estimate that leads to the conclusion that there is 90% probability to have an internal rate of return included between 7% and 10%. And let's assume a normal distribution, okay? So this is the result of your simulation and your analysis in terms of probability, okay? Your critical limit, well, you want to make sure that the probability of an internal rate of return lower than 5% will be lower than 1%. Okay? Here on the screen, on the top, on the left side, I give you some, it's a reminder. Normally, these are things you should know. It tells you the distance in terms of standard deviation, depending on the probability you consider. If you look at, for instance, the first line, if you take 5% here, okay, on the extreme of the distribution, the distance from the mean, the limit would correspond to a distance from the mean, which would be 1.65 standard deviation. Okay, if you consider only 2.5% at the extreme of the probability curve, the normal probability curve, then it could correspond to a distance from the mean of 196 standard deviation, and so on and so on. Indeed, the smaller the probability you take, the longer the distance from the mean. If you take only 1% at the extreme of the probability distribution, the distance from the mean would be 2.33 standard deviation. These are numbers which I recommend you should keep in mind because they are useful. Okay, so here we are. We know the range of value between 7 and 10% with a 90% probability. And our critical limit is 5%. And the probability of getting less than this should not be higher than 1%. So, is the project acceptable? Okay, how can we do this? Well, so you see, my range of value is between 7 and 10. In other words, it is centered on 8.5%, which is the mean. Okay, the expected value of the internal rate of return. Okay, and between these two red lines, then you have 90% probability under the curve. Okay. So now it means if we have 90% probability between the two red limits, it means that on each side, because it's symmetric, you have 5%. Okay. In other words, if you have 5% on each side, the distance between the mean and the limit is 165. You look at this table, 165 standard deviation. Okay. From this, we can infer the standard deviation. Because you see, the distance here is 1.5%. Okay. And it corresponds to 165 standard deviation. Hence, you can say that you consider that the standard deviation of the distribution of the internal rate of return is 0.91. That is 1.5 over 165. Okay. In other words, you know that you are in a situation where the internal rate of return has a distribution which is normal with a mean of 8.5 and a standard deviation of 0.91. Now, is that acceptable? Where is your limit? Your critical limit is for 1%. Okay? So, what is the value of this limit? If you take 1%, you see it's 233. In other words, the distance between the mean and the limit would be 233 times the standard deviation, which is 0.91. In other words, you would find 628. If you have a distribution with a mean of 8.5% and a standard deviation of 0.91, okay, it means that you have 1% probability to be below 628. Okay? Where is your limit? Your limit, your critical limit is 5%. Okay? 5% is on the left side of L. Okay? Is on the left side is because it is lower than 628. In other words, the probability to have less than 5% is obviously lower than 1%. And therefore, you can conclude that the project is acceptable. Okay, this is a rather simple approach, but this is the way where you can use indicators to see if a project is acceptable or not. And now, since you have a lot of number crunchers, believe me, when you have projects and you have models to describe the risk and analyze the risk, and determined probability distribution, and this type of calculation are made more and more frequently. Now, whether it's reliable or not, that's another story, because it all depends on the quality of your assumptions. You know, I tell you between 7 and 10% with 90% probability. Is that reliable? You know, if you assume it is reliable, then you can use the numbers which are there. But you know, it's always the same story. There is a kind of subjectivity behind that, which could be challenged. Let's have another to make sure you have understood. I'm not going to spend time, but you can try to do it yourself. Here I'm using the NPV. Your estimate is within a range of minus 100 and plus 400 with a probability of 90%. And therefore, the expected net present value would be 150. Let's say that you don't want the probability of NPV lower than minus 300 be higher than 1%. Is that acceptable? It's always the same story. You know, I'm not going to comment. This is exactly the same type of exercise, except that in this case, we are using the NPV. So I recommend that you look at this to see whether you follow me. Okay. So again, the first step would be to calculate the implicit standard deviation. Then you take 233 because your limit alpha percent is 1%. It's exactly like before, and you find 233. And the project is again acceptable because we find a kind of earning at risk, which is at minus 253, which is lower than, which is bigger than your limit, which is minus 300. Okay. So now that I have finished with all the indicators, okay? The next step now will be, if we have risk, what can we do? Okay, what are the different approaches that can be used to deal with that? So basically, we use risk transfer. You remember what I said yesterday? Project finance has to do with complex contractual schemes with a lot of participants. Okay, and the idea is to transfer this risk. In most of the case, they can be mitigated also through prevention and the like. But most of the risk will be transferred outside the project company. Okay, and I repeat, it corresponds to a kind of optimization of the risk allocation. You, through a contract, you try to allocate the risk to those who participate in the project and who are in the best position, because they have the expertise, to take this or that particular risk. Okay, so I will discuss the main type of risk. The first important risk is the revenue risk. It is important for a project, if you want to secure the cash flow, to secure the revenue. Okay, and when we talk about revenue risk, we could also I will also refer to say a few things about the supply risk. I mean, the type of contract that can be fixed to guarantee the revenue can also be used to a certain extent to guarantee a certain cost of supply. I will say a few words about business interruption, because the business interruption risk is a very important issue for project finance. What if the project is interrupted during a period of time, because it may create huge difficulties for the payment of the huge debt service. The political risk is also an issue because many projects take place in countries where you have a kind of political instability. Okay, even though it's maybe not the case of Vietnam, I think it's good for you to know, if you do business in the region, that there are some regions where political stability is not that big. Okay, or there is a risk, and how to deal with it. Insurance would be the solution, basically, an insurance policy, which is a kind of contract, by the way. Few ancillary contracts, which shall we mention, and I will have a final discussion about the efficiency of contract management. One of the problems for large companies involved in this type of very capital-intensive project with long-term project is that, you know, there are inefficiencies in contract management. And that's a very important point to be discussed, which I will discuss at the end of this session about contracting and risk transfer. So let's start with the revenue risk. And I will focus on the case of a concession or a BOT case, build, operate, transfer. You have a concession for a period of time. So you build the project, you build the infrastructure, you operate it, and at the end of the concession, the assets are transferred to the public entity. Okay, this is typically what we mean by concession. So in this form of PPP, remember that PPP stands for public-private partnership. Well, the government defines and grants specific rights to an entity, a private company, which is actually the project company. And to build and operate a facility, it might be a power plant, for instance, for a fixed period of time. Might be 20 years, for instance, 20 years of operations, okay, to build a facility and operate it. Even for a tollway, it can be a 20-year period. So the sponsors will have the responsibility when they launch the project company to build the tollway. They will operate the tollway and collect indeed the revenue from it, okay, and repay the debt through this their revenue, and also provide a remuneration for the equity holders. And at the end of 20 years, well, the tollway will become a public asset. Then probably the state will decide to maintain the toll, people having to pay it, but the money will go in the public pocket rather than going to the shareholders. Okay, so to build and operate a facility for a fixed period of time, the government may retain the ultimate ownership of the facility, okay, and or right or supply the services. Okay. Well, so now what about the payments? The concessionaire pays to the government for the concession right, and the governments may also pay the concessionaire, which it provides under the agreement to meet certain specific conditions. Well, what is meant here is that those who are operating, they get a certain revenue, okay, and part of this revenue can be used to pay the state which gave the concession, okay, or the revenues might be kept by the state and then paid to those who are operating. They're receiving a certain amount of money to operate the facility. It can be both ways. Usually, such payment by the government may be necessary to make project commercially viable and or to reduce the level of commercial risk. The problem is that for many public infrastructures, well, if you operate on a purely private with purely private rules, well, there is too much uncertainty about the revenues, and even what you can expect might be, for sure, less than what is necessary to justify an investment by private investors. Okay, in this case, well, the government has to pay something to make sure that it will, at least as a government, a kind of subsidy to make sure that the profitability of the infrastructure will be high enough and attractive for the private sector. Okay, so this is so in this case, what we have, it's a very common case for all type of public infrastructures. So you have a kind of deal between the state and the private entity, and the idea is to guarantee, to make sure that the private entity can count on a safe revenue. Okay, so that you can count on safe cash flows that will be used after that as a guarantee for the lenders, which have no recourse except the cash flow generated by the project in the future. Typical concessions period range between 5 and 50 years. It's totally, 5 and 50 years is a very large range, okay? But it depends indeed on the type of project. And you can use it for many types of public infrastructures. I mentioned the case of roads, airports, it can be power plants, it can be jails, prisons. The British have done this a lot. The private entity would build prisons and so on, and they might operate in the future. Okay, Well, any public, facility can be developed in this way. Well, under a franchise, the concession, where sometimes you have, rather than a BOT, you have a franchise, and there's a franchise arrangement. The concessionaire provides services that are fully specified by the franchising authority. In other words, there is a very specified service which is demanded by the concessionaire, and the private sector carries the commercial risk and may be required to make investments. Okay, and this form of private sector participation is historically popular in providing urban bus or rail services. Okay, in this case, usually, investors consider that they can make a return out of that. Okay, they just guarantee that they will provide a given service. So, how to deal with the revenue risk? I will describe what we call an offtake contract. An offtake contract is a contract that stipulates how much the client, the public client, will buy and under which price conditions. In other words, the objective is to lock in a significant amount of future revenue and allow the project company to account for recurring sales and profit for many years into the future. Why? Because the objective is always the same. You have to keep that in mind. You need to secure future cash flows. Then an offtake contract is a way to secure future revenues. You have take or pay contract, which are rather common. It requires the off-taker. The off-taker is the client, the one who is going to consume the service, okay, or the product, okay? So the off-taker will pay for the product on a regular basis, whether or not the off-taker actually takes delivery of the product. Whether you take it or not, you pay for it, okay? This will be typically the case in electricity business. Take and pay contract, the off-taker only pays for the product taken at an agreed price basis. So in this case, you don't guarantee that you will systematically buy, okay? But each time you buy, you fix the price at which you will pay the service or the good, the product is fixed. Throughput contracts applied when the user of a pipeline, it's typically applied for pipelines, which are huge infrastructures, and a lot of project finance concern pipelines. Well, then you agree to use the pipeline to carry not less than a specified volume, so that you get an agreement on a minimum volume of product at a minimum price, okay? Power purchase agreement. I will develop that later on because that's an interesting case. It's an offtake agreement commonly used with electrical power projects in developing countries. In this circumstance, the off-taker is usually a government and a government entity, typically the grid, the TSO, as we call it, a state transmission operator that is required to buy the power or utilities. Okay, you produce electricity from the project, and there is a power purchase agreement that guarantees revenue for the electricity you produce. And it also, as we'll see, it guarantees the payments of fixed costs, because the fact is that with electricity, you may not need it, so you don't buy electricity when you don't need it, because you cannot store it, okay? In this case, you will pay for the fixed costs, because even if a plant does not produce electricity, the fixed costs are still running. You have contract for difference, hedging contracts, long-term sales contract. I'll let you read all these things. It's just to get you an idea of the vast range of possibilities that exist to fix the revenues of a project. So what type of so let's this covers to these are kind of complement to the former slides. Let's focus now more for you to have a better understanding of how it works on the case of a PPA, which is a power purchase agreement, purchasing power agreement, sorry, so that you have a clear understanding of how typically an offtake contract is built. contract will stipulate actually two things. If the project concerns a power plant, that's typically the case with the case we have seen in Vietnam with the wind farm. Okay, there are agreed technical characteristics. Okay, with the this would apply more to, let's say, a gas power plant. Okay, so let's assume a gas power plant rather than, it will be more complete, more interesting for us for comments. Okay, to look at a gas power plant, what we call usually combined cycle gas power plant, which are the best technologies that exist right now. Okay, so agreed technical characteristics in terms of power, capacity to produce electricity. Okay, and at any time, well, the plant has to maintain a minimum required availability. Okay, then we will agree on a tariff. And the tariff usually consists of two components. What we call an availability charge. Because whether, the problem again is that sometimes you don't need electricity because people don't consume electricity. So far, it may change in the future, but we cannot store electricity. So you have to produce electricity only when electricity is demanded, when there is a demand for it. Okay? So it may happen that there is no need for your power plant. You will not be required to produce because there is no demand for it. Okay? But you still have fixed costs. So it's normal that if you have to maintain a capacity to produce electricity when needed, at least your clients have to pay for the fact that you still have costs when you are not producing. So you have included in the PPA an availability charge to cover the fixed cost. And indeed, when you produce electricity, if you have a gas power plant, you will consume gas, and maybe also have a variable cost, and therefore the PPA will include this charge in the payment. Okay? So what is the availability charge made of? The fixed operating cost, typically scheduled maintenance. Whether you use the plant or not, for safety reasons, you have to make sure that the equipment is working, is in good conditions, and so on. You have some staff, whether you produce or not, you have fixed personnel, you still have to pay them. The same if you are renting some equipment or renting the part of the building, well, you have to pay the rent. Okay, all these are fixed operating costs which are identified in the PPA contract agreement. Okay, then you have a debt service. Whether you produce or not, you have to pay the interest and the principal repayment. So you should have a certain amount of money included in the agreement that would allow you to repay that. Okay, and you don't have debt only, you also have equity holders, even if they bring the lowest share of the fund, with about, let's say, 30%, for instance, well, they expect a return on their equity. So you will include in the availability charge a reasonable return for equity holders, a fair return for shareholders. Well, indeed, there may have long discussions about what is a fair return. Okay? And indeed, there will have discussions about how do you determine the fixed cost and so on, because, rather than you can negotiate a reasonable equity return and, let's say, overcharge as a fixed cost level. Well, this is indeed an issue because one of the problem behind, and you can see that with the point here, one of the problem with the PPA, with the PPPs, private-public partnerships, and with this type of contract, it's corruption. Indeed, because it may be a way for some bureaucrats who are involved in this type of project to agree with a high fixed operating cost, which would be actually higher than that would be what would be normally justified, and this would generate a margin that would provide a higher return for shareholders, but also that would kind of generate a surplus that could be used to pay for, let's say, corruption. Okay, so that's why in many countries the PPP have been discussed and are constitute a hot topic, just because behind that you have a huge risk of corruption, and in many countries it happened. Okay, and that's where it happened, in the negotiation of fixed costs, where you can, if you overcharge there, you can generate a kind of surplus that can be shared after that between equity holders and some bureaucrats trying to benefit from the deal. Okay, apart from the availability charge, you have the energy charge, which will be the cost of purchases. Typically, if you have a gas power plant, you have to pay for the gas you use to produce electricity. So how are you going to determine this cost? Well, that's where you have some pre-agreed assumption as to what we call, in this case, the output-input ratio. Okay, for a certain technology, well, we know roughly what is the quantity of gas you need to produce 1 kilowatt of electricity. Okay, 1 kilowatt hour of electricity. So based on this, we use this ratio to determine how much you need to be paid. Okay, and based also on price of gas, which usually would be fixed with another contract with the suppliers, and which will be taken into account, this price, to fix the cost of purchases and the energy charge, as we call it. Okay, it is pre-agreed, but indeed it can be indexed because you cannot assume that the price will remain the same over the 20 coming years if you have a 20 years concession. Okay. So you have tariff indexation, as I said, and the tariffs are usually adjusted with reference to agreed economic indices. The indices which are selected depends totally on the nature of the project. Indeed, you have to take an index which is relevant with reference to the type of project. And there are indeed penalties which are included in the PPA. Particularly if the plant does not perform as required. If you don't have the capacity which you are expected to have, which is stipulated in the contract, then you can have indeed a penalty. Okay, so you see, with this type of PPA, okay, well, it's a good example to explain how you can guarantee the revenue. Then, based on this, if you have such a PPA, assuming that the public entity is a reliable entity, if it's not, then you may cover your position with an insurance, political insurance, as we'll see later on. Okay, but you see here that you have secured your revenue. Okay, and therefore it will simplify your risk analysis because you know already that revenues are fixed. Then after that, and that most of the costs are covered also. Then you may still have a problem of volatility with the cost, but at least the main source of risk, the revenue, are covered with this type of contract. And it is absolutely necessary, okay? It's because we have PPA that we can have project finance with 80% or 70% of debt financing the project, because you have this high level of security for the revenues. So let's have a kind of case here, just to be a bit more precise on that. So this is a gas power plant with real numbers. CCGT stands for combined cycle gas turbine. Number of years of utilization, 20 years. Size in megawatt, 830 megawatt, which is quite common for this type of plant. Okay, you can see that it is much, much bigger than what you can have with wind turbines. Capacity factor 80%. It means that you can use the plant 80% of the time. Okay. Again, if you compare with wind turbines, it's another story because if you have onshore wind turbines, the capacity factor would be only 25%. If you have offshore, it might be around 40%. In any case, much less than what you have with a gas turbine. So what is the investment cost per megawatt? These are data which are average data that might be maybe modified slightly today. So since you have 830 megawatt, you can use this norm to calculate the total investment. You have a maintenance cost, which are usually scheduled for safety reason. You know, you have planned for maintenance, so they are usually well known. It's a fixed cost for the year, which we think would be around 600,000. What are the operating expenses per megawatt hour? 3.8. Okay. The fuel cost per megawatt hour would be 31. Okay. And the cost of funds, let's assume it is 8%. And for the sake of simplicity, we will assume that it is one-shot capital expenditure year zero. Usually, for such a plant, it may be developed over 4, 5, 6 years, and therefore the investment expenditures would be spread over this period of time. Okay, here, just for the sake of simplicity, we assume that we just spend the money year zero, and we start producing immediately after. Okay, so determine the annual payment, including the availability charge and the coverage of variable cost, assuming a 60% utilization factor. In other words, we're assuming here that the demand, even though you could use 80% of the time your plant, you estimate that the demand will correspond to 60% of the time used. Okay? What is the cost per kilowatt hour in this case, and by how much would this cost be reduced if we assume the cost of funds is only 6%? Here we have a cost of fund which is 8%, which is a kind of mixture between the cost of debt and the cost of equity, okay? Or which is the required return for those who are investing in the plant. Well, so first of all, we need to know what would be the, remind you that the first question is determine the availability charge. You know, it would include essentially fixed cost. So if you look at the fixed cost, you have to pay for the debt service and the remuneration of the investors based, when I say the investors, I mean the lenders as well as the equity holders. The cost of funds, considering all the investors, is 8%. Okay? So how can we determine this here, in this case? Well, what is the amount to be invested? The amount to be invested, the capital expenditure, is 456,500,000. Okay, why? Just because we need to spend 550,000 per megawatt, and the plant corresponds to 830 megawatt. Okay, so this is the capital expenditure. So if you are using the plant during 20 years, okay, and if you have a cost of fund of 8%, well, one way to have a kind of annual charge that corresponds to this investment, considering a cost of funds of 8%, you can just take the annuity that corresponds to this amount for 20 years and 8% rate. Okay, so I provide you with the formula which you have seen in corporate finance. This is, you know, let's assume that the rate is 8%. Spending today 456,500,000 is equivalent to having this charge on a yearly basis. You know, it would be exactly the case if you wanted to use a leasing financing tool to finance your plant. Okay, and the annuity would include the depreciation, that is the repayment of the initial investment, plus the cost of funds. Okay, so taking the annuity gives you an idea about the fixed cost due to the investment to cover the amount invested and which is depreciated year after year, and also the remuneration for those who have given the funds in the first place. Okay, so what you need to add is the other fixed cost. The only other fixed cost which we have here is 600,000 for the maintenance cost. Okay, so the availability charge would be 470,000. 47,095,533. Okay, including the annuity plus the maintenance. Now, what about the variable cost? what do you pay per megawatt hour? 31 for the fuel cost, and the other operating expenses, which is 3.8. Okay, in other words, 34.8 per megawatt hour. The utilization factor is 60%, which means that the plant will produce 60% of the time. Okay, so the cost is 34.8 per megawatt hour. How many megawatt hour do you have? 830 installed capacity in terms of megawatt times 24 hours per day, 365 days in a year, and you take only 60% of that. So the total for 60% utilization factor would be 151 million, 84, and so on. Okay, so the total payment for the year should be close to 200 million. Okay, including both the availability charge as well as the availability charge as well as the cover of the variable cost. And you see that this cost depends to a certain extent of the rate you use for the annuity. In other words, for the cost of funds, the return for the investors, which would include the cost of debt, okay, as well as to a certain extent, for a certain proportion, the cost of equity. Okay? So if you are able to reduce this cost of funds, for instance, if you can benefit from guarantees from the World Bank or from coverage from ECAs, export credit agencies, okay? Or if the state can provide guarantees so that the risk would be lower for the project, so that equity holder normally should be less demanding, then you might reduce this 8% and move it down to 6%. So what would it be with a rate of 6% rather than 8%? We would have the same calculation as before, but we would use 6% rather than 8%. And we see that the result would be, in this case, only 45.6 cost per megawatt hour. Okay. And in other words, a drop for the total payment, the cost per megawatt hour, which would be of minus 3.37%. In other words, by reducing the cost of funds, you can also reduce the price at which you pay the electricity for the state, and therefore also the price that you will demand from the consumers, from the public. Okay? And that's why you always have tough discussion concerning the interest rates and the return offered to equity holders in project finance, because it has an impact on the price to be paid by consumers at the end. So that was the first important point concerning the revenue risk. Now, it's another type of revenue risk which we are going to look at, because one other problem that might occur is that a business interruption. And a business interruption would mean an interruption of your revenue. Okay? So how can we deal with that? So now let's have a focus on a specific case of revenue risk, which is the business interruption risk. So you have a project that is going on. Okay? So you have the time axis, and the horizontal axis is time, and you have the amount of sales or revenues, if you like, from sales, which is assumed to grow regularly like this. It could grow like this if, for instance, you have a kind of indexation. That would be typically the case for a tollway. Usually you have an indexation because you have to take into account the increase in operating costs and so on due to inflation. So you can expect that your sales would normally increase regularly like this. So, and the dotted line is you are at a point in time and you look at the future. You have anticipated sales, okay, while the project is running. And all of a sudden, for any reason, you may have, for instance, if it's a power plant, you might have an explosion, or you may have a kind of in a chemical plant also a kind of business interruption due to cyber risk, for instance. You have probably heard that now it's more and more frequent. Some activities are totally interrupted because of an interruption of their IT system. Okay, well, though that may happen. In this case, what happened? All of a sudden, you have a drop of your sales because part of your capacity is reduced. Okay, part of your capacity cannot be used. So you have a first parameter to analyze the interruption risk, which is a breakdown rate. It might be 50%, for instance, if you have a power plant with 2 turbines, maybe 1 turbine might be interrupted. You have only 1 left, which means that you would have 50% of your activity interrupted, okay? Which is here what I call the breakdown rate. Well, now it may take a certain time before you start again. So the other parameter would be the interruption period. For how long? It depends on how fast you are able to rebuild the destroyed or interrupted capacity. No? If, for instance, you have an explosion, maybe you have to rebuild the facility, to replace the equipment and so on, and it may take time, you know. Once you have rebuilt everything, you can start again, and then you have a recovery period. You have a recovery pattern, C. Well, as you see, it may take time before you come back to normal, okay? It depends on the type of activity. If you have a power plant, well, it would be a straight line, because as soon as you can produce electricity again, well, you are connected to the grid immediately and you start again providing electricity. But if the project was, let's say, a hotel, a big hotel project, well, it may take time before you have your customers coming again to you, okay? In this case, you may have some difficulties to come back to normal. You may spend a bit of money to attract consumers again with marketing expenses and the like, okay? So you see, the business interruption will result in a certain decrease in sales. And the decrease in sales will depend on the size of each of these parameters, okay? If you have a huge breakdown, a long interruption period, and a slow recovery, indeed, the situation will be worse, okay? But what counts essentially is the importance of fixed costs, okay? Why is it important, fixed costs? Because, you know, fixed costs are still there even though your sales are going down. When sales are going down, maybe you will reduce, not maybe, for sure, you will reduce your variable cost, okay? But fixed costs remain there. And if you have huge fixed costs, okay, then you will have difficulties because the drop in sales may lead to a severe cash problem, okay? So if you want to mitigate the risk, you have to find ways to limit the size of these parameters. For instance, to move back to a situation like this one, okay, with a smaller value for A, and basically by avoiding bottlenecks, okay? Because if you have a bottleneck, that's typically a problem with the IT system. That's why in most activities you need to have a backup, because in case your IT system is out of order, all of your activity is interrupted, usually, because it has become a bottleneck. That's why, you know, the cyber risk is such a big risk today, okay? So you should avoid the bottleneck. Then you have to be prepared for a recovery plan. How are you going to do to accelerate the recovery? It means, for instance, you have to be ready to cope with rebuilding a facility that has been destroyed. Do you have the plan? Do you have the administrative authorization to do so? You should anticipate that. And by anticipating that, you may win months, several months, okay? For instance, if you have a very unique equipment, okay, with few suppliers, it might be wise to have a special agreement with your supplier of technology to say, well, in case we have an accident, you would commit yourself to give us a kind of priority in providing a new equipment so that we can restart fast, okay? To accelerate the recovery and reduce the interruption period, as well as, because if you are the shorter, I mean, the value of B, I mean, if the interruption period is not too long, then you can recover rather fast. If you are for a long time away from the market, well, it may be trickier and trickier to come back to normal, okay? Well, So what are the solutions? Well, solutions are, one of the solutions is the contingent business interruption policy. Okay, and I give you here a reference if you want to know more about it. But this insurance policy actually would provide you with compensation for these lost revenues, and typically to cover fixed costs, to cover the lost benefits, also the lost net income, okay, and sometimes also for extra expenses to recover faster, to accelerate the recovery. For instance, you may need to spend more money to accelerate the transport of a crucial equipment. You know, usually, for instance, if you ship a new equipment to recover fast, if it takes, for instance, 3 weeks for the transport period, maybe you can, rather than doing it by sea, you can doing by air. It will be more expensive, but the extra expense will be worth spending because you may reduce by 3 or 4 weeks the delay to get your new equipment. Okay, and this can be covered by the insurer because the insurer will also gain by reducing the period of indemnification. Okay. So what are the main causes of business interruption? The cyber incidents are key. Is a key risk today. Okay, it is considered as a main threat by the entrepreneurs and business people, the business community. These are data from Allianz, which is a major leading insurance company. Okay. Indeed, you have fire and explosion, very common in some activities, particularly for chemical plants or even some power plants and the like. Natural catastrophe, that's also something which is more and more important to take into account. Supplier failure, it became, a concern. You remember Fukushima, for instance. In the area of Fukushima, you had a lot of suppliers for certain type of equipment. And the fact that their business was interrupted created a huge problem for certain companies in the world which were too dependent upon these specialized suppliers. Machinery breakdown is another reason. So, here I gave you a few indication about the type of insurance that exists for that. Okay, the standard BI, if you look at it, this is from Allianz, but believe me, most insurance company, I don't want to advertise for Allianz, but most insurance company would provide very similar insurance policy. So the standard BI would ensure loss of income and ongoing costs as a result of property damage to an own business facility. Okay, you need to have an insurance indeed for your property, and it's part of your cover. You have a loss of income. Contingent BI, it is extension to BI insurance that reimburses lost income on ongoing costs and extra expenses. You see, extra expenses resulting from an interruption of business caused by a property damage at the premises of a customer or supplier. You see, it can, because your business interruption could be due also to the failure of a supplier. Okay, if you still, for instance, you have a power plant, a gas power plant. If your gas supplier does not supply, you are interrupted. Okay, the business interruption can cover this type of risk. Okay, non-damage BI, ensuring loss of income on ongoing costs from interruption of business caused by a situation where there is no physical damage to the insured, the supplier or customer. For instance, if you have a business interruption which is due to, let's say, a pandemic, for instance, it has nothing to do with damage to your facility, but it may cause a business interruption because there are new regulations in the country that says that people have to stay home and the like. Okay, in this case, it may work. You may benefit from the coverage. Data-driven, this is a cyber BI, which is a policy which is specifically designed for the cyber risk that may cause an interruption. But it's a tricky kind of insurance because, there is a moral hazard issue there. Because if you have insurance, then people may not care about the cyber risk because they know that the insurer would pay. Okay, and it's a bit, there is an ethical issue here because it may favor, the development of corrupted activity. Not corrupted activity, but let's say hackers activity. Well, so these are some details of this business interruption risk, which is an important risk in project finance that at least it's very difficult to predict because you never know when it's happened and so on. It's kind of, unpredictable. Okay, that's why the solution in this case is insurance, and insurance is very important. Lenders would not accept to bring their money if there is no insurance of that type. Now, I told you that the political risk was also a concern, particularly because many project finance development today are in emerging countries where you may have a kind of political instability, where institutions are not yet quite stable. And as I said, it may not be quite the case in Vietnam, which is seen as a kind of rather safe country as far as the political risk is concerned, but it may be the case in countries around yours. Look at, for instance, even Thailand, Indonesia, and the like. Okay, so what does it mean, political risk? What does it include? Well, I took this matrix, which I feel is rather clear, and which very quickly tells you what it includes. And in this matrix, you have on the line you have risks which are firm specific, or which could be, in this case, project specific risk, okay, or country level risk. It can be something that concerns a particular company or a particular project, okay, or it can concern any company in the country, okay, or the two columns. Then either it may come from certain attitude of the government, a change coming from the governments and penalizing the project, or it can be a kind of what we call instability risk due to the atmosphere, the environment, the social environment in the country that may lead to some movements and so on that have a negative impact on the activity of firms. Okay, so what do you have, for instance, in the first block? Firm-specific government risk, discriminatory regulation. The government might decide to have specific regulation concerning your activity, the activity of the project, okay? And that would create a negative impact on the project. Creeping expropriation, that is, well, if it's a PPP, it's a bit different because there is an agreement with the government, but there are some activities which might be finance with project finance, but purely private. But then you can have the willingness of the governments to take control of this private activity, okay, and that would be that is a risk also to be considered. And breach of contract, indeed, that's true for PPPs. You have some commitments from the public entity, but maybe the public entity, you have a changing government and they change the rules and so on, and therefore it may impact severely the project, okay? It may impact a specific project, okay, but it may also, government risk also concerns all companies doing business. They might decide the nationalization of all private companies, so it's much nationalization. It's not one specific company which is concerned, but that would be all private investors. Regulatory changes, okay, with new taxes and so on that would apply to all, or currency inconvertibility, that would be a problem to transfer the money, for instance, to cover the debt service, to transfer the money to foreign lenders, for instance. Okay, so it's clear. Well, what about instability risk? Typically sabotage, kidnappings, firm-specific boycotts. Okay, one company which might suffer from a boycott for any type of reason, which might be political or whatever. Okay, mass labor strikes that would concern all the companies doing business in the country, urban rioting, okay, and civil wars indeed. Well, so these are the main type of things that might happen, which are considered as part of the political risk. Now, do you have solution? The answer is yes. Again, you have insurance. You have typically particularly for investment in emerging countries and rather unstable emerging countries. You have MIGA, which is a subsidiary of the World Bank. Okay, the Multilateral Investment Guarantee Agency provides political risk insurance and credit enhancement. You remember what credit enhancement means? It's kind of credit insurance, providing a guarantee for lenders in case of political risk. To investors and lenders to facilitate foreign direct investment in emerging economies. If I remember well, I gave you a document about this, but if you want to read more about that, well, you have the website, which is just indicated below. Okay? So, these are the main comments I wanted to do concerning this contractual agreement. The main aim, as you can see, is to stabilize revenue, because when you try to predict cash flow, indeed you have the cost, but you can use contract. I didn't develop supply cost. For instance, for a power plant, you can have a supply contract that would stipulate the quantity you buy and the price. So very similar to a PPA, to a purchasing power agreement, but it's on the other side, because rather than selling, you buy energy, you buy gas. Okay, so you have similar contract to stabilize the cost. So you see, if you can stabilize your supply cost with a contract with a provider of gas, and if you guarantee your revenue with a PPA, okay, with a public entity on the other side, so you have a full guarantee on both sides, the supply and demand side. And therefore, you have a kind of highly secured cash flows that will allow a large amount of debt to be used to finance the project. Okay, and for the other risk, well, you have all this solution and particularly political insurance. Okay, so you have all these contracts, but are these contracts quite reliable? That's a point which we have to discuss later. Well, I just mentioned here the other important contract, which I'm not going to go through in details because each contract is kind of specific, but you also have a major portion of the risk during the construction phase. So where in project where the construction is an important element in total cost and the total risk, well, we should look in detail at the EPC contract, engineering, procurement, and construction contract. But indeed, it's difficult to have a very general approach to that. It's so it is really totally dependent and specific to each type of construction. Okay, if you want to construct an expressway, a tollway, or a chemical plant, or an hotel, or whatever, the contracts will indeed be totally different. But these are very important contracts in project finance because, and their objective is again to allocate the risk to those who can take the risk because they have the expertise, and to provide a kind of guarantee to make sure that the project company will be very safe. Well, operation and maintenance, O&M. Maintenance is very important for certain types of project, typically in the power industry. Okay, so usually the maintenance is provided on a long-term based contract by external participants. Usually, in many cases, the sponsors are also involved in the project through operation and maintenance contract. They are specialists in handling the technology, usually, and they operate and they can accept to take part of the risk because they are experts in the field. You also have input supply contract, as I said. An input supply contract is very similar in its spirits to a PPA to a certain extent because it's a way to guarantee the supply in terms of quantities and prices. It's very similar to an offtake. Okay, if you look at offtake contract, well, you have some details that tells you about input supply contract. Permits and government support agreements, okay, to guarantee, for instance, that you will have the right to operate during a certain period of time, okay. The weakness of that is the political risk, If you deal with a very serious government, then it's okay. If you deal with governments in a country where you have a high political instability, then you may need political insurance. And insurance, of course, that is used, as we've seen, to cover some risk for which there is no other solutions. Okay, escrow account, I already mentioned what it is. and you have the definition here. So these are many types of what we call ancillary contracts, which are used. Okay, and I did insist indeed on the revenue contract, which is a central point. You know, securing the revenues is indeed the key point in project finance. So now, to conclude on this analysis of the various contracts which are commonly used in project finance, now I want to discuss contracting in general, contracting which can be seen as a risk transfer. Okay. Why do I say it is a risk transfer? Let's assume we have a deal together. Let's assume we have a joint project and we want to sign a deal, to sign a contract between us to develop this project. Well, indeed, what will we find in this contract? We will try to analyze a project and we will determine what is the contribution of each party. What is your responsibility in the project? What are my responsibilities? Okay? And in other words, you are trying to see what are the different things that may happen. Okay? What are the different situations we might be facing? And we will stipulate in the contract what each of us has to do. What are our duties? What we can expect from each other. Okay? And when we do that, what do? We share the risk. Okay? We look at the different risks and we look at how we are going to handle this and who is going to take this, who is going to take this. And indeed, if one of us is taking more risk, then this one will deserve a higher income. Okay? So you can see a contract as a way to share risk and revenues. Okay? If you want to be more precise, what is a contract? A complete contract eliminates opportunistic behavior. What does it mean, this phrase? Being opportunistic means that if you want to have a deal for the future with a partner, okay, maybe you cannot, your idea might be that you cannot trust your partner, you know, that he might, in the future, if he has an opportunity not to cheat you, but to make money at your detriment, well, he will try to do it. Many people would consider that that is life. Okay, so to avoid this, it's better to have a contract to say, well, let's look at the future, what might happen. If this happens, I do this, you do this. I do this, you do this, and so on. We define duties of each party and responsibilities, okay, to make sure that nobody will try to take advantage of the situation, okay, at the detriment of the other party, okay? So to start with, and that's a kind of problem to a certain extent, we have a contract because we don't trust each other. Okay? Contracting has to do with avoiding opportunistic behaviors. Okay? So it stipulates each party's responsibilities and rights for each and every contingency that could conceivably arise during the transaction. Okay? So basically, at the heart of contracting, you have risk analysis. What can happen in the future? Okay, if this happens, what do we do? Who is doing what? What are your responsibilities? If you deal with a supplier, for instance, with a constructor, okay, what might happen? You are responsible for this, this, and this. And I'm responsible for this and this. This is what you find in a contract. What is what I expect from you? This is what you have to do. Whatever the situation, that's your problem. And if this and this happen, then I will take care. Okay, so you see, you stipulate the responsibilities of each party, you know, depending on what would happen in the future. So I repeat the phrase, it stipulates each party's responsibilities and right for each and every contingency that could conceivably arise during the transaction. Okay? So, what is the problem there? So you see, that's why I write also that traditional contracting has to do with planning for the future. You try to see what the future might be and who is doing what. Okay? First of all, it may be ambitious. It is definitely ambitious, I should write, rather than it may be. Because contracts are necessarily more or less incomplete. How can you make sure that you are going to anticipate all things that might possibly happen in the future? Okay. Inevitably, things might happen that you didn't anticipate. You know, it may not be true what I say for a very traditional, basic, simple contract. For instance, if you buy a car from your, let's say, car seller, actually there are typical contracts that exist. There are long experience about it. This is a kind of simple transaction. So there are duties, the contract is well done, everyone knows about it, it's clear, and so on. And there is not much ambiguity there. But in project finance, when you have a contract to develop a technology that will be operated during 20 years in very difficult conditions, in an environment that you don't know perfectly, you know, with a technology which is proven, but you still have new technologies coming up, and so on and so on. How can you imagine that your contract will be complete? Necessarily, the problem is that you should consider that there are things that might happen and which will never be identified when you sign the contract in the first place. Okay, so all contracts are incomplete. And then the question is, what do you do when something that happened is not in the contract? Let me tell you, if you look at it's interesting, you know, you probably know I told you that I spent part of my life in Asia. Okay, and I had the opportunity to discuss about contracting with some local business people. And well, it has changed now because being serious about contracting is part of professionalism. Okay, but you know, the Asian business community was not so familiar and so keen with contracting because, you know, a tradition was, it has changed a bit, it's true, but the tradition was that, you know, you do contract with people you trust. You do business with people you trust, and you don't need contract, because if there is any problem, we sit and we discuss on how to do things. Okay, because how can you imagine what the future is going to be? Who knows? Okay. At the opposite, you have the Americans. They are very professional, you know. They would do everything with contracts, okay? And they would have all types of details, and they would be very good at doing. They are very professional in doing exactly what is stipulated in the contract, and that's why they are, to a certain extent, so efficient. They are good at analyzing the situation. There are a lot of lawyers. They are a bit boring with that, but you know, they are very precise contracts, sometimes difficult to understand. But that's why they try, and they like to import their language, of course, because their language, you know, if it is used, they put them in a stronger position indeed. Okay, but you have to know one thing. The Americans, when they have to deal with a situation where the contract says nothing, they are lost. And they really don't know that. They are very bad at handling situations which were not anticipated. Okay? And in your history, maybe you could observe that. Okay? Well, so contracts are incomplete. And when it comes to project finance and very complex projects in very difficult situations, you cannot consider that you will solve all the problems with contract because it is too ambitious. Not only it is incomplete, but even if you have anticipated some contingencies, well, it may be too vague in the contract. The way it is stipulated in the contract might be too vague. I remember a case, you know, it was a contract concerning the provision of an engine by a company for an aircraft manufacturer. Okay? Within the contract, they did stipulate what should be the power of the engine. Okay? But there was a case, and it took 10 years to solve the case. Can you imagine this? Why? Because there was an engine, and the client said that the power was not like it should be as stipulated in the contract. The problem is that the way the measure of the power should be done, as stipulated in the contract, was so vague that they couldn't agree on how to measure it. Okay, that's an example of vagueness which took 10 years to be solved with very expensive lawyers. Okay, so understand me well. I'm not telling you that contracting is a bad thing. I'm telling you that you have to do contracts is a good thing. It's very professional because it forces parties to investigate into the future, to analyze the risk, and you understand how important the risk analysis is. Okay, so that's an important point. But don't count on contract to solve all the problems you will have to deal with in the future. Okay, in the end, it may prove very costly because you have contract litigation and delays, which are very important. You know, the cost of a run very often comes from this. The fact that contracts are not complete They are vague, and sometimes you have huge delays due to the fact that there is a disagreement between parties. Okay? Contract litigation and delay. It may prove very costly. It may also reflect unfair practices. You know, when you have two parties, it's a question of transparency. You know, ideally, all the parties contracting together should be transparent. They should say everything. Normally, that would be ideal, because then we would know everything about the situation. But, you know, when there are two parties, usually they have their own information. Why do you think they should share the information? You know, everyone agree to say now that information has a lot of value. So why if you have information which others don't have, why would you give it? If it has value, there is no reason for you to give it. Okay, so the concept of transparency, which is very much used today, saying that everything should be transparent, is kind of ridiculous to a certain extent. If we continue to say that information is very valuable, why should you give it? Okay, so when you have two parties contracting, okay, well, each of them have their own information, and they may perfectly keep the information which is not necessary. They know that they might benefit from a certain situation, but they don't tell it if the other one is not aware of that. Okay, so you may have some incomplete contracts coming from the fact that both parties keep part of the information for themselves, because they know that behind this there is an opportunity for them to benefit from the situation. Let me give you a practical example of that. You know about facility management. Now companies when they have a facility, they want to maintain the facility, they want to clean it and so on. Rather than doing this directly by themselves with their own people, they would buy a facility management contract from an outside company. And they would discuss to design the contract. They would discuss all the possibilities, everything. So the facility manager is an expert in facility management. He knows a lot of things about buildings, about what needs to be repaired, what needs to be maintained, and so on. He knows much more than the client. Okay? So what is he going to do? He's going to go and say to the client, well, what do you need? What do you expect from me? And the client will give a list of tasks, a list of things that should be looked after, okay, repaired regularly and so on. And the facility manager will be, okay, no problem for that. And usually would provide you with a good price to make sure you get the market, okay? With a good price, and you are happy with it. Except that the facility manager, when he signs a contract, he knows that there are lots of things which will have to be done, but which you as a client have not identified, okay? And that's the way he will make money. He will make money by coming to you later, okay, we signed this contract, you asked me to do this and this and this, but look at this. You know, it's very dangerous if you don't do it, you have a safety issue there. And then he will say, okay, I can do the job, then he will charge extra. And he will charge so many extras like this. That is its main source of profit. So to start with, the facility manager will sign a contract which looks very cheap. In the end, you will spend a lot of money with this facility manager, because he will come to you and tell you, yes, but this is not in the contract, remember, and but you should do it, and you will have to do it, okay, and spend more and more money. He knew from the very beginning that you would have to do that, but he didn't tell you, because, you know, now he's making more money. He's taking this as an opportunity for making money. And it is well known today that it is at the center, at the heart of the business model of facility management. Okay, so that's an example of what I call here a kind of unfair practice. Okay, due to, as we call it in the economic literature, as you know, information asymmetry between parties. Okay. There is a cultural issue also. Well, I mentioned that a bit before because, as I told you, you have the difference between an American and an Asian business person. An Asian business person would, to a certain count and trust, and they are right to a certain extent for complex project, whereas a typical American would not count on trust at all. He would say, no, we need a contract. We need to write down what each of us is doing. Okay, it is to a certain extent highly professional. It is necessary to do so. What I am saying is that if there is no trust at all, it won't work for complex situations. And in project finance, you most of the time are dealing with complex situations. That is, the main reason for the failure of project is a lack of trust between the people who are developing the project. And typically between, when you have PPPs, between bureaucrats at the government and the business community. Okay, so building trust is not an absolute, is a kind of necessity for complex project as a complement to contracting. Okay, that's something that should be clearly understood. And if you look at the failures of many projects, they come from the fact that people were not able to work together, counting too much on contracts rather than on personal relations. Okay, so because contract is so important, the last thing to do to deal with that is to look at the way to build an efficient contractual policy. Okay, and I will conclude the discussion with an analysis of what we call the contract life cycle to put forward the major approach to contracting that would lead to, let's say, more efficient contracting. So the contract life cycle is made of two phases: the creation of the contract with analysis, specification, and choice of the contractor. Once the contractor is chosen, so you go for it, you have the second phase of the contract life cycle, which is the management of the contractual relation. Okay? So if you have a project, you have a project company, and you need to remember to outsource the risk, putting together all types of participants around the project company. Okay? So for each of the participants, for each contract you're going to sign, you need to know why you have this contract. You need to analyze the exact needs of the project company. What are the tasks and duties you expect from the assets outside, which can be transferred outside the project company? Okay, and who are the potential contractors? What are the risks if you transfer the activity outside in comparison with doing it yourself inside the company? Okay, what are your needs exactly? Why do you need a contract? Of course, it is obvious to say so, but believe me, this analysis is not always properly made. People deciding just they're going to take someone outside to do the job without having thought really what exactly you need from the outside contribution. Okay? The question is also who should be in charge. Those who should be in charge should indeed be those who are going to operate, okay, and to be involved in the transaction. So now, let's assume that this has been done. Now you are going to move to the next phase, which is specification. Well, we know what we need. We have a clear view of what we expect from the external partners to provide us with, okay? Now you have to design a clear document, okay, where you explain clearly what you need, okay? You need to write a detailed proposal so that contractors can make a relevant offer. You need to tell to the outside people, well, this is what we need. Who is ready to answer our demand, our request, okay? So who is writing this? Usually you need lawyers for that because you have to be very precise. You have to be very clear to avoid any ambiguity, okay? That's why you need lawyers, and that's a problem. Why? Because those who are writing this document usually are not those who have contributed to the analysis. And this is the first source of, let's say, of distance between what is really needed and what is stipulated, specified in the request to look for an external provider, okay? And that's a tricky phase to a certain extent, okay? And those, why? Because those who are participating are not the same. You have to make sure that they understand each other well, which is not always the case. Why? Because you may not be a specialist in law, and even if you're a lawyer, you may not be a specialist in a specific domain of law, and that's why, you know, it may be tricky in the end, okay? So then you have the choice of a contractor. You have a specification. It has been sent to all type of potential companies that could provide the service, Okay? You have to choose. Who is going to choose that? Well, now, usually you have specific personnel, those who are responsible for purchases, who are going to be involved. So you see another group of people will come in. And normally, well, those who have made the analysis in the first place, they are very much concerned. So they should contribute to the decision. They do contribute, but not alone. Those who are in charge of purchases, they tend usually, even if they say it's not that much the case, but they tend to look at low prices. You know, if they can find they look at good value for money, but good value means very often low prices for the service. And you have to be careful because you probably know the story. If you pay peanuts, you get monkeys. Okay? So if you just look at the low price of the service, it may not be a good way to do. But you always have people within the company, those who are looking at the the accounts and so on. They try to push for a low price of the service. You know, and sometimes those who are needing the service because they will be involved later. Well, they tend to like to work with people they know well, they trust. They know they're doing a good job, even if they are a bit more expensive. But you know, you have discussion here at this level, which might again create ambiguity and a wrong selection of the appropriate provider. Okay, so it is signed. You have seen just through these 3 steps how difficult it is to end up with a contractor and all the weaknesses that might appear if there is no good coordination at the 3 stages. What comes next? Startup phase. Why a startup phase? Because, you know, those who have made the decision, who have been involved in the creation of the contract, on both sides, on the client and the supplier side, are usually not those who are going to manage the contractual relation. Okay? On the supplier side, usually you have the commercial team. The commercial team has been involved. And the commercial team will not be involved in implementing the service after that to provide the service to the customer. Okay? On the customer side, those who have decided for which supplier should be selected, well, they are not going to be involved in managing the contractual relation after. Okay? So those who are going now to start to work together, they were not involved in the first place, or not enough often. So this is a phase that is useful to make sure that there is a common understanding of each party's task and responsibilities. Those who are going to work together, it's better. You have to make sure that they really understand. Normally, this phase should not exist. If the contract is built in a proper way, normally there shouldn't have such problem. But in real life, it's reasonable to consider this phase, okay? And to make sure that the people would be prepared to work together and agree on what each party has to do, okay? What are the responsibilities of each party, okay? And if there are some kind of mismatch which are identified in this very early phase, well, you have to ring the bell and say, well, there is a problem there, maybe we need to adapt something, okay? Once this is done, then you can move, and that's more normal, to the execution of the contract with monitoring and control of the adequacy of contractors' delivery. Are the providers doing what we expect from them? Okay, you have to proceed to the payments. Is that made properly? And the necessary adjustment due to circumstances which might have been anticipated before or not. And sometimes, if you have no, let's say, flexibility, because the contract is, as we said, often incomplete, you may have to deal with situations which you are not anticipated. And again, if there is no trust, if you have not built trust to start with, and the startup phase is also there for that, to try to build trust between people working together, so that when something happened which was not anticipated, okay, then they can sit together and say, well, let's work together. We know how to work together. Let's go on. We're going to try to find a solution. If they are not able to do that, they will go through litigations with cost overrun and delays. And then you have the closure indeed. It can be as planned if everything went well, or by anticipation for any type of reason. You have to verify that all what was supposed to be done has been done, all due services have been fully delivered. And that's an important point. You have to identify potential claim. You know, at the end of the contract, you may have some problems, some difficulties later on, if the provision of your equipment of the service was not as it should have been. Okay, so if there are potential changes with different parties later on, you need to identify possible potential either to write provision or to identify clearly the responsibility of the provider. Okay, so here when you see that, you understand why contracting is not an easy task. Typically, what are the problems? What are the key questions? Who does what? The problem, many people are involved in the building of the contract. And these people, if they don't work together, if they don't understand them well together, if there is a lack of coordination, well, indeed, you may end up with contracts which are poor contracts, which will lead to difficulties later on in the second phase while the contract is executed. The key questions are who does what, okay? And what about the coordination along the life cycle? Believe me, for large companies which are involved in large project, infrastructure project, this is a major concern, okay? Because they have many subcontractors they deal with, there are many contracts to handle, and improving the efficiency of their contracting activity is a key element. Okay? Well, so relational contracts are, this is a description of how to build a traditional contract. Okay? Well, the conclusion was what you have to build is also trust. Okay? So rather than saying trust, in the economic literature, we have a concept which is equivalent to trust, but which we call relational contracts, a necessity when facing complex situations. Okay? It is not a substitute for traditional contracts, but it is a complement. So a formal classical contract is legally binding document between at least two parties that defines and governs the rights and duties of the parties to an agreement. Okay? This is how we have defined a formal contract. Okay? A legally binding document. Because of incompleteness, losses may arise and the party is lost from opportunistic behavior. You say incompleteness means that we have to consider that, particularly when you have complex situation, some contingencies might happen which were not anticipated. How do you do with that? Okay, okay. If you have nothing, if you never thought of it before, okay, well, you have poor cooperation because of not enough trust between contracting parties, and you may it may lead to inefficiencies and extra cost. A relational contract, I'm defining here, is a contract whose effect is based upon a relationship of trust between the parties to which it pertains. In explicit terms of the contract are just an outline. You just take the traditional contract as a document which exists, which you can use, but there are also implicit terms and understanding which determine the behavior of the parties. If you have a relational contract, you have norms of behaviors, okay, an implicit understanding of how to do things, even if it's not written, okay? And you have a joint risk management. It means that you have to be ready to cooperate between the different parties to handle the risk, knowing that you cannot anticipate all the possible contingencies. It would lead to a better risk assessment, an optimal allocation of risk between parties, okay, and enhanced preparedness and capacity to adapt to unexpected events. Okay? So you have a table here which you can look at that shows the difference between a formal and versus a relational contract. We can look at it quickly if you want to conclude on that discussion. It is inspired from a famous author which you may have heard of, Williamson. What are the criteria? Let's look at the identity of parties. In a formal contract, identities and personal attributes of parties are irrelevant. It's Mr. X, Mr. Y, but who you are doesn't count. It's a legal document. You have the different party, you have the buyer, the seller, and so on, but your individual personality doesn't count at all. In a relational contract, it's the opposite. Identities of personal attribute of parties are crucial. If you are friends, it's better. Okay? Duration of the relationship. It specifies a discrete duration when you have a formal contract. Well, in a relational contract, there is no duration stipulated. If you have a friend, you are not going to tell him, well, let's be friends during 1 year. We'll see in 1 year from now how do we do. No, indeterminate duration. Okay. How to deal with contingencies? Contingencies and penalties for non-performance are specified in a formal contract. In a relational contract, you have norms of behavior or shared code of conduct. Let's discuss. Let's behave properly according to norms we agree upon. Okay, let's have a code of conduct, not to cheat, not to try to take advantage illegitimately from this situation. Let's behave, because we know that today I benefit, but maybe next time it will be your turn to benefit, and so on. It's a balance over time. It's, a way to handle a project that lasts over time. You might be a winner today, okay, or you might agree to be kind with your partner today. Maybe the last time he will be kind with you, so that it creates kind of stability over time. Role of written documents. Written documentation overrules any verbal agreement for a formal contract. In a relational contract, written documentation treated as record of what has been agreed. Okay. And it doesn't mean that it is the absolute truth. If you just realize that the situation is different from what had been imagined in the first place, you can decide, both parties can decide to diverge from what was agreed upon some years ago. Dispute and procedures. Law courts adjudicate in the event of disagreement. Well, in a relational contract, norms of behavior or shared code of conduct overrule written documents and settling disputes. I like to say that for dispute procedures, it's better to have a good dinner with a good bottle of wine with the other party and have a good discussion, rather than spending 5 or 6 years with very expensive lawyers to find out about solution. Okay, so I have finished with contracting. Okay, if you want to read further about this, you have some readings here, and I have finished with that. So tomorrow we will start the project evaluation, which is the third phase, which is a much more technical and important phase. Okay, so I think it's time to finish now. Let me just look. Okay. See you tomorrow. Okay. I don't see where you are. I have lost your. I've lost the discussion. Is there any questions somewhere? Okay, see you. So have a good dinner. Maybe you had dinner already, but I'm going to have dinner now. Okay, so see you then.